Okay, picture this. You're running a big company. A major lawsuit just lands on your desk. Or maybe your brand new flagship product is showing a serious defect. How in the world do you account for a disaster that hasn't actually happened yet? Well, today we're diving into the financial rulebook for uncertainty, how companies have to prepare, on paper, for a totally unpredictable future.
You know, every single business faces these what-if scenarios. A customer could sue. A new gadget might turn out to be a dud. And these aren't just headaches for the legal team or the engineers. They create a massive problem for accountants. I mean, their entire job is to paint a true and fair financial picture of the company, and that means they somehow have to put a number on the great unknown. And in the world of accounting, these what-ifs get a formal name, a contingency. It's basically any situation where a potential gain or a potential loss is just hanging out there, waiting on some future event. You can think of it as the official term for being in financial limbo. So here's our game plan. First, we're going to cover the basic rules for handling these uncertain gains versus losses. Then we'll take those rules and apply them to a super common example, product warranties. We'll even break down the two main types, put your knowledge to the test with a couple of scenarios, and then wrap it all up by talking about why any of this actually matters in the real world. All right, so you're an accountant and you're staring at all this potential chaos. How do you bring some order to it? Well, it turns out there's a surprisingly simple playbook, and it all kicks off by asking one really important question. The very first step is just to gauge the likelihood. Honestly, think of it like a weather forecast. Is this event probable? You know, the storm is already on the radar and it's heading your way. Or is it just reasonably possible? The clouds are gathering, but it might blow over. Or is it remote, like a tiny slight chance of a drizzle? This simple forecast is going to determine everything that happens next. Now, for a potential loss, there's a really strict two-part test you have to apply before you can officially record it. First, is the loss probable? And second, can you reasonably estimate the dollar amount? It's a simple yes or no for each one, but you absolutely have to have two yeses to move forward. And right here is the crucial fork in the road. If a loss is both probable and you can estimate it, the company has to accrue it. Accruing is just accounting speak for formally recording an expense and a liability right now on the books before any cash has even left the building. But if you only get one yes, or if the loss is just reasonably possible, the company discloses it in the footnotes instead. It's the difference between officially taking a hit to your bottom line versus just giving investors a heads up about a potential problem down the road. But here's what's so interesting. The rules totally flip when you're talking about potential gains. See, accounting is designed to be conservative. So with gains, like maybe winning a lawsuit, you can't record a thing until the gain is realized. That basically means you don't count your chickens before they hatch. The money has to pretty much be in the bank. You can talk about it in the notes, sure, but you can't book the income just because you've got a good feeling about it. Okay, so we've got the theory down. Now let's apply this whole framework to one of the most common contingencies any business has to deal with. Just think about it. When a company sells you a new phone with a 1-year warranty, they're making a promise that could absolutely cost them money later. They have no idea which specific phones will break, but they know from experience that some of them will. And that uncertainty makes a warranty a textbook example of a loss contingency. At its core, a warranty is just that simple promise to fix or replace something if it's faulty. But here's where it gets really interesting for accountants. There are actually two fundamentally different kinds of warranties, and how you account for them couldn't be more different. This right here is the critical distinction that changes everything. We're talking about assurance type versus service type warranties. One is just part of the product you bought, the other is a whole separate product in and of itself. So, an assurance type warranty is that basic guarantee that just comes in the box. It assures you the product will work like it's supposed to. You can't buy it separately, it's just included. This is your classic loss contingency. A service type warranty, on the other hand, is that extended warranty the salesperson tries to sell you at the checkout. It's an additional service you pay extra for, and because of that, it's treated as a completely separate sale that generates its own revenue over time. So for those standard, in-the-box warranties, companies have to estimate their future costs. Here's the logic they use to track it. They start with whatever liability was left over from last year. Then, they add a new expense estimate for all the products they sold this year. And finally, they subtract the actual repair costs they paid out. Whatever's left over is the amount they're still on the hook for to cover future claims. Let's make this real with a quick example. So, in year one, this company sells $300,000 worth of products. They figure their total warranty costs over 2 years will be about 8% of sales. That's the 3% plus the 5%. So, they recognize the entire $24,000 of warranty expense right away in year one, even though most of those costs won't hit until year two. Then, when they actually pay for repairs, it just reduces the liability they already set up.
Now, those service-type warranties, the extended ones, that's a whole different ballgame. Since you paid extra for it, the company treats that money almost like a subscription. They can't recognize all the revenue at once. Instead, they earn it bit by bit over the life of the warranty contract. And instead of estimating costs up front, they just record the repair expenses as they actually happen.
All right, you've seen the rule book. Let's put you in the accountant's chair for a minute with a couple of quick scenarios.
First one's up, your company is getting sued for $500,000. Your lawyer gives you the grim news. There's an 80% probability you're going to lose the full amount. Looking at the options here, what's the right call? Okay, let's run it through our two-part test. Is the loss probable? At 80%? You bet it is. Can it be estimated? Yep, a clear $500,000. We've got two yeses, so the answer has to be A. The company must accrue that loss right now to give a true picture of its financial obligations. All right, one more for you. And this one is a little trickier. This time, the lawyer says a loss is only reasonably possible, not probable. They think the potential damage is in a range, somewhere between $250,000 and $500,000. So how much should be accrued? The key word here is the probability. The loss is not probable. It's only reasonably possible, and that means it fails the very first test for accrual. So even though we can estimate an amount, we can't actually book it. The correct move is to disclose the whole situation in the footnotes, but the amount to accrue on the books is zero. The answer is A. So after all those rules and tests and different types of warranties, let's just zoom out. Why does getting any of this right matter so much? Look, this isn't just about accountants following rules for the heck of it. This whole framework is about creating a level playing field. It makes sure that investors, banks, and really anyone looking at a financial report gets a consistent, honest view of a company's potential risks. It stops companies from hiding their likely problems in the fine print or from booking some fantasy profit that might never happen. It's really the foundation of financial transparency. And this really gets to the heart of the challenge, doesn't it? We have all these clear black and white rules, but so often they hinge on a subjective judgment call. I mean, what's the real difference between a 70% probable and a 60% reasonably possible? That gray area is where the art of accounting meets the science, and it's why understanding these principles is so important if you want to see the real story behind the numbers.